Imagine cutting your monthly student loan payment in half without taking on more debt. Sounds impossible, right? Well, it's not. There's a way millions of Americans are lowering what they owe each month, saving thousands over the life of their loans, and even paying them off years sooner. And today, I'm going to show you exactly how. But here's the catch. Most people do it wrong. They refinance at the wrong time, with the wrong lender, or for the wrong reasons, and end up regretting it. Stick with me, because by the end of this video, you'll know the exact playbook for getting the best refinancing rates and avoiding costly mistakes. Number 1. What does refinancing mean, really? Let's start simple. Refinancing. A student loan means taking your existing loan and replacing it with a new one, usually with a lower interest rate. Think of it like trading in your car for a newer model with better gas mileage. You're still driving, but now you're saving money every time you hit the road. For example, if you owe $30,000 at a 7% rate, that interest adds up fast. Refinance at 4%, and suddenly you're saving hundreds every year. The goal is straightforward. Get a better deal on the money you borrowed. Number 2. Why should you even care about refinancing? Here's the truth. Interest is the silent killer of your finances. It's like a leaky faucet, dripping money out of your pocket every single day. When you refinance, you can shrink that leak or even stop it. Take this example. Emily owes $40,000 at 6.8%. That's about $273 per month just in interest. After refinancing to 3.5%, her interest drops to around $117 per month. That's an extra $150 staying in her pocket every month. That's the power of refinancing. Number 3. Federal versus private loans. What's the difference? This part confuses a lot of beginners. Federal loans come from the government. Private loans come from banks or lenders. Here's the catch. When you refinance federal loans into a private loan, you lose federal protections. Things like income-driven repayment, forbearance, and potential forgiveness programs vanish once you switch. So, refinancing can save money, but it can also close doors. Imagine you're giving up an umbrella on a cloudy day because the sun came out for a moment. If it rains later, you're stuck. That's why you need to weigh the benefits carefully. Number 4. When is the right time to refinance? This is the million-dollar question. The best time is when interest rates are low, your credit score is solid, and your income is steady. For example, if you've been making payments for a couple of years, built up a credit score above 700, and have a stable job, lenders are far more likely to offer you a great deal. But if your credit is shaky or your income uncertain, it might be better to wait. Remember, refinancing is like shopping for a mortgage. Timing matters. Number 5. Fixed versus variable rates. What's better? Lenders often give you a choice. A fixed rate stays the same forever. A variable rate starts lower but can change over time. Think of a fixed rate as a steady boat in calm water. It won't rock much. A variable rate is like a speedboat. It feels exciting at first, but if a storm hits, you're in trouble. If you want peace of mind and predictability, fixed rates are usually the safer bet. Variable rates only make sense if you can pay off the loan quickly before they rise. Number 6. How your credit score impacts rates. Lenders love low-risk borrowers, and your credit score is their way of judging your risk. A score above 750 often unlocks the best rates. A score under 650? Not so much. For example, Jake with a 780 score refinances $50,000 at 3%. Sarah with a 640 score refinances the same amount but gets stuck with 6%. That difference can cost Sarah over $8,000 more in interest across the life of the loan. Improving your credit before refinancing can be worth thousands. Number 7. The role of income and debt-to-income ratio. Lenders don't just look at credit. They also check your debt-to-income ratio. This number shows how much of your income goes toward paying debts. If you make $4,000 per month and $1,200 goes to debts, your ratio is 30%. Most lenders want this under 40%. The lower, the better. So, if you can increase your income or pay off some debts before applying, your odds improve dramatically. Number 8. How long should you refinance for? You'll usually get to choose your repayment term. Shorter terms mean higher monthly payments, but less total interest. Longer terms mean lower payments, but more interest over time. It's like choosing between sprinting and jogging. Sprinting gets you there faster, but it's harder. Jogging takes longer, but it's easier. For example, refinancing $30,000 over 10 years at 4% means paying about $304 per month. Stretch it to 20 years, and it's only $182 per month, but you'll pay double the interest overall. The choice depends on whether your priority is cash flow today or savings tomorrow. Number 9. Hidden fees you need to watch out for. Not all refinancing offers are created equal. Some lenders tack on origination fees, prepayment, penalties, or other hidden costs. It's like buying a cheap flight, only to find out you're paying extra for bags, seat selection, and even water. Always read the fine print. A slightly higher rate with no fees might actually save you more than a lower rate packed with hidden charges. Number 10. Where do you actually refinance? Good news, there are tons of options. Online lenders like SoFi, Earnest, and Common Bond. Traditional banks, credit unions. Each lender has different strengths. Some offer lower rates. Some give flexible repayment terms. Some even offer perks, like career coaching or financial planning. The key is to shop around. Compare at least 3 offers before making a decision. Number 11. What happens to your old loan? Once you refinance, your new lender pays off your old loan. Then you make payments to the new lender under the new terms. So yes, it's one loan replacing another. Nothing sneaky about it. For example, if you had 3 different loans, refinancing could combine them into one monthly payment. That alone can make life easier. Number 12. What are the risks of refinancing? Refinancing can be powerful, but it's not perfect. If you give up federal protections, you may regret it later if your income drops or new forgiveness programs roll out. Also, if you refinance and then interest rates fall further, you might feel stuck with a higher rate. So the risk is locking yourself into something that may not be ideal for the long haul. Number 13. Can you refinance more than once? Yes. Just like you can refinance a mortgage multiple times, you can refinance student loans more than once. If rates drop or your credit improves, you can apply again. For example, Mark refinanced at 5% 2 years ago. Today, rates are at 3%. He refinances again, shaving thousands more off his balance. So don't think of refinancing as a one-time shot. It can be a long-term strategy. Number 14. What documents do you need to refinance? Usually, you'll need proof of income, your student loan details, identification, and sometimes tax returns. Think of it like applying for a new credit card, but with more paperwork. Being organized helps speed up the process and makes you look more reliable to lenders. Number 15. How to get the absolute best rate possible. Here's the part you've been waiting for. To unlock the lowest refinancing rates, you need 3 things: excellent credit, steady income, and a low debt-to-income ratio. Boost your credit by paying bills on time and lowering credit card balances. Increase your income, maybe through a side hustle, and knock down other debts before applying. Also, apply with a cosigner if you can. Having someone with great credit back you up can cut your rate dramatically. Finally, don't rush. Compare multiple lenders and use their offers against each other to negotiate. This is where thousands of dollars can be saved or lost. Number 16. Can refinancing help your credit score? Yes, it can. When you refinance and make on-time payments, your credit score may improve because you're showing responsible borrowing behavior. But at the same time, applying for refinancing will trigger a hard credit inquiry, which may drop your score slightly at first. For example, Alex refinanced his loans and saw his credit score dip by 5 points right away, but after a year of consistent payments, his score went up by 40 points. Number 17. Should you refinance if you're close to paying off your loans? If you only have a small balance left or just a year or 2 of payments remaining, refinancing may not be worth the effort. The savings from a lower interest rate would be minimal compared to the time and paperwork it takes. For example, if you owe $2,000 and plan to pay it off in 12 months, the interest savings might only be $50. In that case, keeping things simple is often better. Number 18. Can you refinance both private and federal loans together? Yes, you can combine them into a single refinanced loan. But here's the key. You'll lose all federal protections on the federal portion of your loan. For example, if you have $20,000 in federal loans and $15,000 in private loans, you could refinance them together. But if income-driven repayment was important to you, you would want to leave your federal loans out of the refinancing process. Number 19. Should you refinance if you want loan forgiveness? If you're aiming for programs like public service loan forgiveness, refinancing is usually a bad idea. Why? Because once you refinance, your federal loans become private. Loans and private loans don't qualify for forgiveness programs. For example, Maria, a teacher, is 5 years into the forgiveness program. If she refinances now, she'll lose all progress and miss out on potentially having tens of thousands forgiven. Number 20. Do cosigners really make a big difference? Yes. A cosigner with a strong credit history can drop your rate by 1 to 2% or more. That may not sound like much, but on a $50,000 loan, even a 1% lower rate can save more than $5,000 in interest over 10 years. But keep in mind, your cosigner is legally responsible for the loan if you can't pay, so only use someone who understands the risk. Number 21. What if you lose your job after refinancing? This is a scary thought, but important to consider. Unlike federal loans, most private refinancing options don't automatically offer income-driven repayment plans. However, some lenders do have unemployment protection programs, allowing you to pause payments temporarily. For example, SoFi offers forbearance for a few months if you lose your job, but not all lenders do. This is why reading the terms of your loan is critical before signing. Number 22. Can refinancing reduce your monthly payment without lowering your rate? Yes, by extending your repayment term. For example, if you owe $30,000 over 10 years, your payment might be $350 per month. If you refinance into a 20-year loan, your payment could drop to around $200 per month, even if your interest rate stays the same. This helps with cash flow today, but costs you more in total interest over time. Number 23. Are there tax considerations when refinancing? Yes. Interest on student loans may be tax deductible up to a certain amount, depending on your income. When you refinance, this doesn't go away. You can still claim the deduction if you qualify. For example, if you pay $2,000 in interest in a year, you may be able to deduct part of that on your taxes, lowering your taxable income. It's not the main reason to refinance, but it's a nice perk to keep in mind. Number 24. Should married couples refinance together? Some lenders allow spouses to combine their student loans into one refinanced loan. This can simplify payments, but it also ties both people legally to the debt. For example, if one spouse loses their job, the other is still fully responsible for the entire balance. It can be convenient, but it comes with extra risk. Number 25. Can refinancing save you if interest rates rise in the future? Yes. Locking in a fixed rate now can protect you from future increases in interest rates. For example, if you lock in 4% today and rates rise to 6% in 2 years, you're safe. You'll keep paying at 4% while new borrowers get stuck at higher rates. This makes refinancing a smart move when rates are historically low. Here's the bottom line. Refinancing student loans can be one of the smartest financial moves you ever make, or one of the most dangerous if done without the right knowledge. It's not just about chasing the lowest rate. It's about balancing savings today with protection tomorrow. So now I'll leave you with this. If you had the chance to cut your loan payments in half, would you take it today or wait and risk losing that opportunity? Drop your thoughts in the comments.